Rising interest rates will impact the market in two ways. One, the companies that have borrowed money on a floating rate basis. And for those that have not engaged any type of hedging activity without providing for caps or outright swaps on their loans, they're going to have much higher costs to capital as interest rates rise. I think what will happen is a lot of those firms will quickly call people like ourselves and some others and say, what can you do to hedge out this risk? There's going to be some costs involved with that to people that, frankly, they could avoid by doing something right now. For now, most of the issuing community seems to be comfortable just riding that risk, which, frankly, we think is a mistake. On the other side of the coin, one of the dynamics in the overall loan market have been the inflows and outflows of the retail investor. And for months now, we've had huge outflows out of the loan funds. I think with interest rates rising, those funds will appear to be more attractive to the individuals who, allocate their funds, and we'll probably start seeing more inflows into those funds. What that translates to is tighter spreads, because as more capital to put to use in an environment where the deal flow is steady, that capital will basically bid itself down in terms of spread to a place where more competitive loans will get placed. The regulations are felt by every bank participant in the marketplace today. And I hear from a lot of accounts that the first question that gets asked when they're shown a loan is not whether it's a good credit, not whether they like the sponsor, not whether they like the industry, but the first question they ask is, will this fit under our current regulatory regime and environment? I've never heard that before in my 30 years on Wall Street. The leveraged lending guidelines basically are forcing the banks into a certain box, and all the banks are playing in that box. And the non-banks are playing a little bit outside that box for now, because they're not regulated. And as a result of that, we've seen total leverage come down significantly and first lien leverage also come down. So I think the marketplace has recalibrated a little bit to basically stay on sides with the regulators. And that is probably going to continue over the next year or so. Middle market executives, I think, today are in the same position they were in last year. They have to deal with understanding new regulatory issues and the environment, including the ACA, tax regiments, and just the general presence of government in many different fields that were never there before. That is a pressure, if you will, for middle market companies. Also, middle market companies today are more global than they were in the past. And as a result, with the rising dollar, companies are trying to figure out how that's going to affect their business and competitiveness on a global basis. I think that 2015 will be a continuation of the lending market that we had last year. For lenders who have the ability to roll up our sleeves and really go granular within industry verticals, I think that in transactions where people try to push the envelope because of the regulations, they're going to have a lot of resistance, and those transactions, if they get done, are going to get done very, very expensively. So I think that throughout this year we'll be very active, but within the middle, if you will, of the risk parameters, and it's going to be interesting to see how the market responds to that, overall.